Everyone loves to hate on bears. It gives people a sense of moral superiority to project onto these people who are doubters in some sort of economic outlook or market outlook that they are just negative people. They are they live insufferable lives. They just want everybody else to feel pain. Nothing about their arguments or any of that. So today I'm going to address everyone's favorite question and favorite thing these days to completely disregard. And that is the possibility that we have a recession. More importantly, the signs that I'm seeing that lead me to be highly convinced that whether or not we get into a recession, because last year we had 2 consecutive quarters of negative GDP, and that is the definition of a recession, but we decided not to call it that. Whether or not we get into a recession, I don't know, because the definition was changed. But I'm here to tell you and show you some signs I'm seeing that lead me to believe that an economic slowdown is ahead of us for sure, or in a highly likely scenario. At the very least, there are definitely clear signs that we're seeing. So let's get into this. I actually made notes for this video. I might start doing this more often. I don't normally do notes, but I'm making notes for this video because there's so many signs. I want to make sure I'm not leaving anything on the table and not forgetting anything. So I don't know how long this video is going to be, but let's go right into it. So the first thing I want to address is food consumption. Food consumption is a rather large area of the budget, but the people at the lower end of things, of consumption, of incomes, are sensitive to this. And everyone likes to eat food. The rich people aren't going to show so many signs, but the lower and the middle class are, and we are seeing definite signs in this area. You hear from Tyson today. That stock was down 10% at one point. They're closing four poultry and chicken plants. Costco, which is a place people go to save money, said at their last earnings call that they are seeing people trade down from beef to poultry, despite Tyson closing down the poultry, and say these are signs consistent with past recessions like seen in the great financial crisis and in the dot-com bubble period. So food, we're seeing signs of this. We're seeing Kellogg talk about how people are managing their inventories in their homes, of their pantries essentially, making sure they don't have waste. People are penny pinching their individual budgets on food compared to where it was. We saw what happened with CMG, Chipotle. We saw what happened with Sweetgreen. I get it. Somebody upgraded the stock later. It rallied. But they're not doing as well as they thought they were doing. And that's very understandable because people are now expecting some sort of, we're past the trough and everything's going to go up here. That's not how I see it. And this, I think, is a big market dislocation. Obviously, we've seen plenty of market dislocations. The market has not reacted to the dislocation coming to fruition in interest rates, but it doesn't matter. We're just talking about what we're seeing. So, there's definitely a pullback in food consumption. But what if that's the only area? That's not the only area. If you listen to a lot of these companies in this area of the economy, the freight economy, they will describe it as a freight recession. And let's not forget, companies are not in any way necessarily incentivized to say that their area of the economy is in a recession. But some of these companies are saying their area of the economy is in a recession. I listened to the JB Hunt earnings call. That stock is somehow, weirdly enough, trading at all-time highs or just about close to all-time highs, despite massive declines in earnings and revenue, and them saying they're in a freight recession using terms like no green shoots. You've got, I don't know how to, I'm pronouncing this correctly, but Maersk, if you look up the name, you'll recognize it if you've ever driven past a port. Maybe you've seen it on trucks. It's a shipping company. They're essentially saying the same thing. Freight recession, lowering second half guidance, while the market has very high and reaccelerating second half guidance and very high earnings next year. Yes, continuation in earnings growth next year. And I find that hard to believe and hard to expect. So we've got essentially a food recession. Signs consumers are pulling back on food. We've got a freight, which is a very important thing, right? You need to eat to survive. This is like not a choice, but yet somehow people are finding a way to pull back in this area. If they were flush with cash, they probably would not be pulling back on food consumption. And this is one last thing before we transition into the more business side of things. People have touted the robust consumer savings due to locking everyone down so they didn't go to restaurants and bars, giving them money, inflating the economy so their nominal savings went up, not their real savings necessarily went up. I haven't done the exact calculation offhand, but it's probably a little closer to the pre-COVID level in terms of real savings. Anyways, we know that the savings in the bank accounts is on a very clear and consistent trajectory down towards the pre-COVID levels. However, the savings rate is below pre-COVID levels and very low. It's only 4 or so percent. That's because inflation is high, budgets have shrunk, the ability to save has declined. Consumers are worse off now than they were pre-COVID. That's what it seems when you look at that savings rate, to me at least. Maybe things change when the nominal savings in the account gets equal or something. I don't know. We'll see. But that is the consumer so far, my reads on recessionary views. Next, we got one more thing on the consumer later. Bankruptcies are higher this year than last year. So if you thought last year was the bad year, this year's the good year, you're SOL, because we're not even done with the year yet, and we already have more bankruptcies than we had last year. This is not something you see in a new bull market necessarily. We have not had many bankruptcies for the last decade. Since the great financial crisis, they have been out of favor. Part of this is because it's been so easy to get financing. The Fed would essentially buy debt in the market, and interest rates were rather low. So, financing costs weren't really a concern. These companies could generally avoid bankruptcy, but that's no longer the case. Companies are starting to have to file for bankruptcy, and that is happening at an accelerating rate, and there's no signs that's slowing down. We are experiencing the most aggressive pace of bankruptcies since the great financial crisis. So, definitely something to keep an eye on. Not something that is in any way bullish. Recessions typically cleanse out areas of the economy of excess. I believe we did have a lot of excess. We had a debt-fueled bubble, and there's going to be a deleveraging, which will clear out plenty of excesses. And I don't think this is the peak of that. I don't think this is, the end of it or anything. I think this is, kind of when it's starting to come into fruition. I think Morgan Stanley is right that the fiscal spending is supporting a lot of things, like GDP, and making people believe that the economy is very strong when we've gone through food, we've gone through freight, we've looked at bankruptcies, and now we're going to look at the credit contraction. Credit is very important for the economy. Let's not forget, there's only something like $2 trillion in cash, right? Everything else is credit. A lot of people spend on their credit cards. Businesses take out loans. If we only relied on cash, it would be a dire picture. But we have credit, and credit is as good as printed money in terms of its effect on inflation, its effect on stimulating the economy. We are now experiencing a near historic credit contraction. You look at the demand for business credit, it's at levels not seen since 2010. Great financial crisis levels. So we are seeing signs of credit contraction. We're seeing auto loan rejection rates at the lowest, or at the highest rather, ever on record. But however, we are now seeing, last month, consumer credit card balances decline. What does that last point mean? Doesn't that mean that the consumer is strong and paying off their balances? Maybe there's some of that by some people because interest rates have gone up, but it means two things. One, banks don't want to lend to consumer credit as much. We know this. We know lots of banks are exiting the auto industry. We know banks have, you've heard on the earnings calls, we've talked about it. We talked about Discover. Increased loan loss provisions basically meaning tightening lending, expecting bigger losses. This is what they're talking about. It also means less spending in the economy. That is a relatively forward-looking indicator based on data we're going to get. Something to note. Consumer-related. And finally, we've got the lagged effects. A lot of people have wanted to call on the Fed to stop hiking for the last several rate hikes because we need to see the lag effects play out. Now that they think the battle is won, these people aren't still talking about the recession because they won their battle. They didn't win the war. Well, the lagged effects, they're still coming. They're still coming. So let's see what happens with that. You raise interest rates like this, you really bring things to a level they haven't been in many years. Maybe there's no effect, but we'll see. These are some signs and some things I'm thinking about when forecasting a potential recession. We'll see what happens. That's today's video, and until next time, peace out.